I want to talk about using trading filters and knowing your exit points on your chart. I'm going to show you something that I do, and I'll show you right now. What we have up right now is the chart of the S&P 500. It's an index that tracks the 500 companies, the top 500 companies that meet the criteria and are accepted into the index. Um, You'll have big companies in here, the Apples, the Amazons. Tesla was just added to the index not too long ago. So this is the index that can give you a gauge of how the market's doing. So, so what I'm going to show right now, you're looking at a long-term chart from 1989 till today of the S&P 500. So right now I have the setting on daily chart. So each bar represents a day. I'm going to zoom in so you can see the bars a little closer. So each one of these bars represents a day. So grab any random day here, September 3rd. It opened at 355. Went as high as 356, went as low as 342, and it closed at 345.39. That's the action of the day. You can also, if you're a day trader, I don't have data on this program. I don't have intraday data on this program, but a day trader might be trading bars that each bar represents 15 minutes. You know, it'll show you the action of the last 15 minutes. The open, the high, the low, and where it closed in that 15-minute span. 5 minute or 1 minute, depends what. They got bars for everything. A half-hour bars. You can even do, 2-day bars, 3-day bars. I have just daily, weekly, and monthly. So here we go. This is the same S&P 500. The only thing I've done is I switched to a weekly bar system. So each bar represents a week. So each bar will represent where it opened on Monday, the high of the week, the low of the week, and where it closed on Friday. And same thing with monthly. Each bar represents the action of a month. So let's go back to weekly, and we can zoom out here. You can see the action here, and we had in 2000 we had the dot-com crash. The movement was more extreme in the Nasdaq. Again, we're looking at the S&P 500. The S&P 500 wasn't as tech heavy as the Nasdaq was, but it still experienced a crash here. So when I'm talking about a trading filter, we're trying to avoid being in the market during these crashes. We have the 2008 financial crash. We had the dot-com crash, which affected the overall market. Even the pandemic. The pandemic was, to me, is like so sudden, and it recovered so fast. I wouldn't even call that a crash. It was like a flash crash. But what I want to talk about is, so back in 2000, trading charts with OBV divergences, even trading charts with favorable patterns that usually make you money, you're still going to lose money during a bear market. So trading during that time is difficult. They say 75 to 80% of the stocks follow the general market. So if the general market is rising, then you have a better chance of making money if you're buying. If the general market is falling, if the general market's in a bear market and the market's falling, why would you trade? Why would you keep trading? Why would you keep buying stocks? And the only reason you'd be buying stocks is if you think you're so good to find the 20% of the stocks that are going against the market. I learned that the hard way in 2000. I lost some money trading during that time because I kept buying the OBV breakouts and they weren't working. I'm like, what the hell? It was working before. What's going on? How come it's not working? Since that time, I've kind of used, and these aren't my ideas. These are ideas that money managers talk about and from reading books. You after a while you'll start to learn that a rising tide rises all boats. Same thing with a tide that's going out, it's going to lower all the boats. So right now the market's going up, Everybody's buying stocks, putting their YOLO their money on AMC, YOLO on this, YOLO on that, Tesla to the moon. The market's going up. It's making all boats rise up. You know, a lot of these people think they're a genius now. They're gonna leave their jobs to become day traders. So I'm just trying to say, like, the market rising is gonna put the chances in your favor to have winning trades. When the market turns, when the cycle turns, and we're in a bear market, even in 2018 here, 2018 we kind of had a flat, choppy market, and the S&P was down 3% for the year on 2018. Even someone trading during this time frame probably had a difficult time making money if they didn't end up flat or negative for the year also. So what I want to show is if there's some type of indicator we can use to tell us to not be in the market. There's all kinds of ideas out there, you know, like moving average. So if I switch back to the daily, people might use, you know, the 50-day crossing over the 200-day moving average. I'm going to zoom in and then scroll back so you can see the chart better. So let's say over here. Here we go. We're zoomed into 2000. The 50-day moving average pretty much stayed above the 200-day moving average from 95 to 98. In 98, it did cross. This could have been your signal to go into cash or stop buying stocks. You could have gotten back in once it crossed over positive again, and you would have pretty much been in it, right? I'm not zooming in to get exact dates, but you get the idea of what I'm trying to show here. Late 2000, it crossed back over. That could have been your signal. All right, let me stop buying stocks, go into cash, and you would have been out of the market. You would have been out of the market all the way into somewhere around May of 2003. So just by using a moving average crossover system, you can avoid a lot of the damage from bear markets. Once you get back in, imagine you didn't lose 50-60% of your money in this bear market. Now that you get the signal to get back in, you're at a head start compared to anyone who was buy and hold and held through this crash. Again, you would have gotten a signal here in 2004, but you would have been back in shortly after. Again, in 2006, you would have gotten some false signals or whipsaws that they call them. But you never know you don't know when you get that signal. You don't know if it's a bear market or just a whipsaw. You have to follow every signal as if a bear market's coming. Again, here in 2008, we had the crossover. Look at the damage that you could have avoided by just going cash. And you would have been out of the market until late, it looks like June 2009, you would have gotten a signal to get back in. So that's some ideas is using a moving average. There's trend lines, you can use a trend line. Trend lines are a little bit more difficult because they're very subjective. You're always going to be drawing the trend line to where you think it should be. So, but yeah, you could use trend lines. Well, I'll just show you one example here in 2000. So if you were using a trend line, let's say like this was your trend line, then that means you should have bought here in April. It's easy to look at the fact now and be like, oh yeah, my trend line would have been here. That's my trend line, and I would have been in cash and out of the market until April 2003. Yeah, that's fine looking at in hindsight, but when things are going down real time, this is what your trend line is going to look like. You know, if you don't see the action, this is what you might be looking at. Well, there's my trend line. Oh, and right here, you should have got, if you're using the trend line, you should be getting back in because you're closed above that trend line. Then later, now you can see in hindsight that that wasn't a good trading signal to get back in. But I mean, you can use trend lines. Trend lines are subjective, and you're constantly trying to adjust the trend lines. I mean, in hindsight, you can say, yep, that's the trend line. That's the trend line you should have been following. But in real time, that trend line was broken several times, giving you signals to get back in. So I'm going to show you what I use. So my buys are still OBV breakouts. I'm looking for OBV divergences or OBV just confirming the move. I use the weekly chart as my stop system, so let's switch over to weekly. So each bar here represents a week. And we'll zoom in. We'll start here with the pandemic crash. So you can see right here on February 21st, my SA stop and reverse indicator was at 321.43, and the week of February 28th, the price closed at 296.26, giving me a signal to get out of the market and stay in cash. So basically all these dots is the stop and reverse signal. Basically I stay in the market until the price closes below that dot. So you can tell here we had the pandemic bounce. We had to bounce off the lows in March. I would have been in. So right here where the crash happened, the stop and reverse level was 296.89. I'd be waiting for a close above that level before getting in. So on the week of 5/22, it closed at 295. So we still 296.89 was the level. We would have not gotten a signal to get back in until May 29th, 2020. That's when I get the signal to go get back into the market. And once I get the signal to get back in the market, the lower dots is my new stop loss levels. So you can see here, even though the indicator flipped, I'm still looking at the lower indicator. The lower indicator is 325.67. I'm looking for a close below 325.67, which is not intraday. It can move below that level during the week, but a close below that level is where I say, okay, I'm going to go to cash. So 325.67. You see right here, the week of October 30th, the price closed at 326.54. It's still above my level of 325.67. I still would have been in cash this whole time. In the market, I meant to say. I still would have been in the market this whole time. What I'm showing you so you can look at this if you want to use this system. You can do it through your brokerage should have a charting platform to look at, and you should have these indicators. You can look at the charts and put these indicators if you want to use this, or any free charting website should have this stuff. But I use a custom indicator, but this is basically what it's using. So let's say where I showed you where we would have been out of the market when the market started to crash. We would have been out February 28th, the week of February 28th. Let me flip over to my custom indicator. See how I have a red bar right there? That's my signal to get out of the market. I would have been in cash. That doesn't mean I sell every stock I own. It means I use this same indicator is what I use on my long-term trading account, which is just saying my decisions are based on the weekly time frame. I'm still buying OBV breakouts. My long-term account tends to trade more large cap stocks that tend to trend, so I'm trying to find strong trends and just ride the trend. If I get this signal on the S&P 500, I'm still following the stops on my individual stocks. It just means I'm not purchasing any new stocks. So if I start getting a bunch of signals in my portfolio, I start selling those, I'm just holding the cash. I'm not getting back into the market. This is my signal to stop buying stocks. Start following your exit points on your individual stocks and build up a cash position and wait for the market to give you a re-entry signal. So which we got the re-entry signal on May 1st. So if I flip over to the other chart, and here you go, you can see the signal was right around that time frame. So you can use this stop and reverse on your platform. You're not going to get this. You're not going to get this one because this is a custom indicator written for this program. But it's the same thing. You're basically just looking at that. It's just visually easier to just look at this and be like, yep, red bar out, green bar in. That's all this is telling me, but it's the same thing I'm showing you on the other chart. The gray bars here is telling me that the risk is higher than 20%. So here this week, the risk was 25.8. If I was to get into this particular stock, I'm risking 25.8% of my money for the price to fall down to the stop level. And the following week, the risk was 27.8. And now the risk is 21.8. So I think I have this set at 25%. So if it's more than a 25% risk, you'll see a gray bar on this indicator. But that's it. That's all it is. Basically, all you're looking at. It's not no secret indicator or anything. It's basically the stop and reverse indicator that you can get anywhere. It's just written in a different type of code that makes it easier to just look at it. So even with the crashes, let me zoom in and scroll back. Even with the crash of 2000 and the crash of 2008, you can see, here's your 2008, it had me out of the market. We did get some signals to get back in, but most of the time it had us out of the market. And same goes over here. Once you start getting these signals, you'll be out of the market. Plus, once this happens, like once you're over here, like let's say on October 3rd and things are crashing, I'm in no rush to get back in the market. At that point, then you can probably use trend lines along with this indicator. So if you're here, you got your trend line way up here. But this is what I use. This is the indicator I use. Once that stop and reverse signal gives me a signal it turns red, then I'm building up a cash position and I'm out of the market. When this starts turning red, that means 80% of the stocks in the stock market are falling. I'm not smart enough to find the 20% that are rising. So let me just step out of the way and try to reduce the damage to the portfolio. As you can see, since the rebound off the March lows, we haven't gotten a sell signal. We haven't gotten a sell signal since the rebound. This indicator has had us in the market this whole time. Another thing I want to talk about is, I know I'm probably giving like mixed signals when like the macro view of the markets. I'm saying, the video where the market is nuts. And I'm talking about how overstretched all the valuations are, that we're making records and everything. A lot of those videos, I'm basing it on people that are just buying something with no exit point. Like new investors that are just jumping in the market and they don't have an exit point. I spoke to someone else this week. They bought Bitcoin. They have Bitcoin. I'm like, oh, really? You got Bitcoin? So I asked them, how'd you get into Bitcoin? Oh, my brother-in-law's rich friend told him to buy Bitcoin. So I bought Bitcoin. And I'm like, oh, that's interesting. So how do you know, like, when are you going to sell? Is your brother-in-law's rich friend going to give you the sell signal? And I just left it at that. I'm always asking, what's your exit point? So when I'm talking about like everything's at an extreme as far as valuations and the market's going to crash, or we're close to a crash, we're close to a top, I'm basing that. I just want to give somebody another perspective that's just buying into the market with no exit point. Like if somebody put a gun to my head right now and said, okay, you need to make a decision right now. You need to put all your money in the market or get out of the market. For the next 3 years, you need to make a decision right now. Is your money going to be in the market right now, today, or get out? We need to know right now. There's a gun to my head. I'd get out. I wouldn't jump in the market without having my exit points. I also said this in 2018, so take that for what it's worth. But a lot of the videos where I'm saying the market's nuts and all that, I'm basing what I'm trying to do is give people who are jumping in the market without any idea of when they're getting out. I'm trying to give them a warning that this is not the environment to buy and hold. You can tell we're trying to avoid a 2000 reduction in your portfolio of 50%. In 2008, again, from 2000, it took 10 years to get back to that peak again. So you want to avoid a crash. But I might be quoting the wrong person. I think it was Peter Lynch who said there's been more money lost in people preparing for a crash than the crash itself. That quote kind of stuck with me, and I'm like, you know what? Maybe we should just follow some type of trend following indicator, stay in the market, because we never know how crazy the crowd's going to get. But being aware that we are at extremes, and that when we get that sell signals, we should not hesitate to act on them. There's one. So I'm looking at returns on the Nasdaq. So just look at these returns. In 1995, the Nasdaq returned 39.92, 96. It returned 22.71. 97, it returned 21.64. 1998, the Nasdaq returned 39.63. In 1999, the year before the crash, it returned 85.59%. I mean, listen to those numbers. Listen to those returns in those 5 years, the last 5 years of that bubble. I mean, you definitely want to participate in those type of gains if they're available. And to say that the Nasdaq was up 85.59% in a year, individual stocks must have been up 200-300% that year. Just nuts. And just right now, in 2019, we've had a return of 35.23. Last year, we had a return of 43.64. 2018 was a negative year. We lost 3.88. And so far, year to date, we're up 8.78. So is it possible that we can have another 2-3 year run like in 1995 to 2000? Sure, it's definitely possible. Am I going to bet on it without having exit points? No. We can easily crash like 2000. Like when I look at charts, I'm just trying to read the charts. Right now the trend is up, so I'm just going to keep following the trend. But when the trend changes, it might be the crash. It might just be a dip or it might be a crash. I don't know. But we need to act accordingly to avoid a crash. Another thing I just wanted to keep in mind is, I'm going to switch over to the Nasdaq. You can use this same system on the Nasdaq. Again, I mean, look at this crash in 2000. In 2008, the financial crash, we had to decline too. But what I'm saying, in 2007, that peak got nowhere even close to the 2000 peak. Took even longer to recover your losses from the Nasdaq. But I want to lay out another scenario that I'm also open to. So in 1998, there was a fund called Long-Term Capital. They went bankrupt, and a lot of the big bankers, the Goldman Sachs, had exposure to that fund. And there was a Greenspan, the Fed chairman at the time, bailed out. He came up with a plan that bailed out the fund so that we wouldn't have what they call systemic risk, and it would spread to the banks. So indirectly, the banks got bailed out. The banks got together. I don't know all the details, but they came up with a package. Rumor is that Bear Stearns and Lehman Brothers did not have exposure to that fund, so they refused to participate in the bailout, which is, and the rumor is one of the reasons why they were left to go bankrupt in the 2008 crash. It was kind of a payback. It's like, oh, you didn't have exposure last time, you have exposure now, you're on your own. And that was one of the reasons they were left. holding the bag and went bankrupt, while Hank Paulson, at the time was Treasury Secretary, an ex-Goldman Sachs guy, was there to bail out Goldman Sachs and Bank of America and everyone else. But I'm getting off track here. I'm going to go on a political rant here. But anyways, long-term capital was bailed out. Greenspan started cutting interest rates, flooding the economy in the markets with free money. He was cutting interest rates because at the time they were scared of a Y2K scare, that the whole world was going to come to a stop because the computers weren't going to know what happens when the year 2000 hits. The whole economy was going to come crashing down. So Greenspan started printing money to just in case there was a crash. And that was like the final 2 years, that spike and all that money that was flooded into the system. Plus the bailout of 1998 sent a signal to all the hedge funds. It's like, don't worry, the Fed's got our back. Who cares if we take risky bets? They'll bail us out. They bailed out long-term capital hedge fund. They bailed them out. So the message was, go strong or go home. So just keep that in mind. So what do we have recently? Recently, we just had our Kagos fund blow up. I don't think there wasn't enough exposure in the banks for it to have systemic risk, but it just shows the amount of leverage that some of these hedge funds are using, that a trade turns against them and they can blow up and go bankrupt. So we have a lot of risk being taken. We have, with the pandemic, it depends whose numbers you listen to, but they're saying anywhere from 25% to 40% of the money in supply was printed in the 2020. That they're printing so much money. They printed so much money that 25% to 40% of the money in circulation was printed in 2020. So, of course, if there's that much free money floating around the system, it's gonna trickle its way into assets, whether that's stocks that shot up, whether it's commodities. We're seeing lumber prices go through the roof. We're seeing everything's going through the roof. Oil, agricultural products, everything's going through the roof. People speculating in cryptocurrencies, that's going through the roof. All this free money is trickling its way to the system. So I can definitely see a situation where we have more money coming into the stock market. Real estate, it seems like everything's going up. We're in an everything bubble, and this bubble might get a little bit bigger in the next year or two before a crash. That's definitely a scenario that I'm open to. But I don't know the future, because if I did know the future, I'd put all my money on that one bet. So that's why we do trend following, and that's why we follow a set of trading rules. So this is basically what I use. Let's jump back to the S&P 500. This is what I use as a trading filter. If I'll come back over here so you can look. This is what you would see on your trading platform. If the stop and reverse, if the price on the weekly chart closes below the stop and reverse indicator, I'm not taking any new positions. And most of the time when that happens, most of the stocks in your portfolio are already getting sell signals. And I use this same system is what I use on my weekly system, is what I use to show me sell signals. So I'm going to take you to this and use this. It's the same thing as what I showed you here. This is what you would see on your platform. Any trading brokerage platform should have this available for you. So, but I use this. It's the same thing. It just makes it easier. So I'm going to take you to my positions that I own. So this is what I own right now. It's Friday. So this is what I do. This is how easy it is. I'm going to show you how easy it is. Do I have any sell signals? So basically I'm just looking for a red bar. Right there, I'm selling this. So once you get this red bar, you have one of two choices. Either just put sell at the market, or if I look at the chart and I'm like, OBB still looks good, or oh, I think the stock's still gonna recover. Regardless, either you're selling or I'm putting a hard stop at the low of that day. So on this case, the low is 220.03. I'm either selling at the market or I'm putting a stop order, good till cancel. If the price closes below 220 and 3 cents, I'm out. And we just keep going. I did get a couple sell signals this week. This is it. This is how easy. Boom. I'm selling this one on Monday or putting a stop. I'm selling this one on Monday or putting a stop. This is a trucking. Like I said, I got into a lot of the trucking and shipping. Well, I got a sell signal. I'm either selling it or putting a stop. That's as simple as that. Do I have any red bars? That's it. Oh, I got another one. Selling or putting a stop. Whirlpool, selling or putting a stop. So I got a few sell signals that I will be placing the orders for Monday. So that's basically it. This weekly, what I call the long-term trading account, kind of takes an approach. I kind of still base my decisions on where the price is with OBV. So let's take this one. I still get in it, thinking of OBV. Is it positive? Am I getting positive money flow? But then once I'm in it, that's it. I'm taking a hands-off approach and let the weekly system let me know when to get out. If the market keeps going up, then I'll go with it. If the market starts dropping, then I get out. So that's basically it. That's a trading filter I use, and I just showed you. That's basically my weekly system that I use for exit points on my individual stocks. But I also use that as a trading filter of when to stay in cash. And you don't have to use that, but you should be using some type of filter. Let me jump back to the S&P 500. You should definitely be using some type of filter that tells you when to go into cash. Whether it's a moving average crossover, trend lines, the stop and reverse like I'm using. You definitely need, in my opinion, you should use something that tells you when to go to cash. Unless you think you're smart enough to pick the 20% of the stocks that are going to go up when we're in a bear market, then go for it. Keep buying stocks. But in my opinion, I think when the market flips to a bear market, when the cycle changes, when the tide is going down, you're better off just stepping aside and go cash and just wait it out till the tide rises again. You know, this is like a game of baseball. You don't have to swing at every pitch. In stock investing, you have the advantage of just waiting there for the perfect pitch. If the environment is it's not a good environment to buy stocks, you don't have to swing. You can get out of the way and just wait for that perfect pitch. Wait for things to turn better and put the probabilities of winning on your side. Don't try to win when the environment isn't conducive to you winning. So that's it. Those are my thoughts. Again, another video that turned to too long, but that's basically what I use for a trading filter. And whether you use that or you come up with your own trading filter or you find someone else's trading filter, it definitely is a wise thing to use a trading filter. And we're going to leave it at that.